does your student loan payment feel like this impossible mountain you have to climb every single month? I mean, what if your bill was based on what you actually earn instead of just the giant number you owe? Well, that is the big promise of a really powerful federal program we're going to break down today, Income-Driven Repayment, or IDR for short. And look, you're not just imagining it. This is a huge crisis. Just recently, a crazy 11.3% of all federal student loans were delinquent. Think about that. That means more than 1 in 10 borrowers were falling behind, just struggling to keep their heads above water. And that number, that's not just a statistic on a screen, right? That's the real life for millions of people. It's that sinking feeling in your stomach when the bill shows up. And that is exactly why programs like IDR even exist. They're supposed to be a lifeline when that standard payment is just impossible. Okay, so what is this lifeline we're talking about? At its core, an income-driven repayment plan just completely flips the script. Instead of being all about your debt, it's all about your wallet. It's designed to give you some actual breathing room. I mean, the name really says it all, income-driven. So you can kind of forget that old standard 10-year plan for a second. IDR figures out your payment based on what they call your discretionary income. And the bottom line is pretty simple. If your income goes down, or maybe your family gets bigger, your monthly payment can drop right down with it. And we are not talking about a small change here. The difference can be absolutely dramatic. For so many people, that standard payment is just not doable. An IDR plan can slash that bill by a huge amount. In fact, and get this, for folks with the lowest incomes, the payment can literally be $0 a month. And your loans still stay in good standing, $0. But a lower monthly payment is really just half the story. The other half, well, that's the long-term benefit that makes IDR so powerful. After you've made qualifying payments for 20 or 25 years, it depends on your plan and your loans, whatever balance is left over is completely forgiven. Just wiped out, gone. All right, that all sounds great, right? But how do you actually do it? How do you make it happen? Let's walk through the official roadmap, step by step, to get you qualified for one of these plans. Okay, before we even get to the steps, I need to be super clear about one thing. There's only one place you should go to do this, and that is the official government website, StudentAid.gov. It's totally free, it's secure, and it's the only tool you need. Please avoid any company that tries to charge you for this. You don't need them. You know, the actual process is way more straightforward than you might think. First, just make sure your loans are federal, because private loans, they don't qualify. You'll need to know who your loan servicer is. Then you can calculate if you're eligible and use the official loan simulator. And this tool, it is your new best friend. It'll show you exactly what your payment could be on all the different plans. After you compare your options and pick the best one, you just submit the application. Simple enough. But it's that last one, step 7, that honestly deserves its own flashing red warning light. Seriously, pay attention here. This is the step where so many people mess up. You absolutely must recertify your income and family size every single year. If you forget, your payments will just skyrocket right back to that painful standard amount. And even worse, any interest you didn't pay could get capitalized. That means it gets tacked onto your loan balance and you start paying interest on your interest. No joke, open up your phone right now and set a calendar reminder for next year. Do it. Okay, so we've got the how. But that brings us to an even bigger question. Should you? Because look, an IDR plan is not a magic one for everyone. To make the right call for you, you've really got to weigh the good against the bad. So let's break it down. On the good side, you've got those lower payments, you're protected from default, and of course, there's that incredible promise of forgiveness. And some of the newer plans, like Save, even have an interest subsidy so your balance doesn't grow. But the trade-offs, they're real. You're going to be in debt for a lot longer. We're talking 20, maybe 25 years. And this is the wild part. For a while, your total loan balance might actually go up if your payment isn't covering all the interest. And that brings us to the biggest potential catch of all. People call it the tax bomb. Under the law right now, that huge chunk of debt that gets forgiven at the end, well, it could be treated as taxable income by the IRS. So just imagine getting, say, $50,000 in loans erased, but then you're hit with a massive tax bill on that $50,000 all in 1 year. Now, this is a hot topic, and the policy could definitely change, but as of right now, it's a very real risk you need to know about. So, wow, that's a lot to take in, right? The good, the bad, the tax bomb. How in the world do you decide what's right for you? It all boils down to your personal financial situation. So let's build a quick little framework to help you figure this out. Okay, let's just cut to the chase. Here's the bottom line. If your total student debt is more than what you make in a year, IDR is almost certainly a tool you should be looking at. If you just flat out cannot afford the standard payment without major hardship, it's a lifeline. But, and this is a big but, only if you promise yourself you'll do that yearly paperwork. If you can't afford the standard 10-year plan, you're going to save a boatload of cash on interest by just paying it off faster. So there you have it. You have the roadmap. You know the facts, you know the steps, and you know how to make the call. The path to a student loan payment that you can actually manage is right there in front of you. So the only real question left is, what's your next move?